Okay, we're going to look at notes payable. A note payable relates to when we borrow money from a creditor. It could be a vendor, it could be a bank. And so we have to recognize a liability. And you'll notice the mechanics for notes payable are identical to a note receivable. Both the note receivable and the note payable can be current assets or liabilities. They can be non-current. They can have a portion of current and non-current. We're simply going to look at a current liability, a 9-month note. And if you watch the note receivable video, you'll notice the date is identical. On September 1st, we borrow $140,000 at 8% annual interest for a 9-month period. So on the day that we borrow the money, we're going to debit cash for $140,000, and we're going to credit notes payable for $140,000. Okay? So our business year end, our fiscal year end is December 31st. It's a calendar year end. And so you notice my timeline here. We borrowed the money on September 1st. At December 31st, September, October, November, December, 4 months have gone by. And we have to accrue. We have to figure out how much interest we have accrued because we owe that money. If you think about it, if on January 1st we paid back this loan early, we'd still owe 4 months interest. And so accrual basis accounting, the matching concept, we have to match expenses to the same time period that they help to create revenue. Then we have to record 4 months interest in the year 2015. So our interest calculation, the loan principal, $140,000, times an annual interest rate of 8%, gives us $11,200 of annual interest. Let's divide that by 12 months and we get $933 of monthly interest. And by the way, we could have divided this by 360 days or 365 days to get daily interest, but we'll use monthly interest. And then again, September, October, November, December, 4 months interest have gone by. So $933 monthly interest times 4 months equals $3,733. So my adjusting entry at the end of the year to accrue the interest expense to make sure it hits this year's income statement would be to debit interest expense for $3,733 and to credit interest payable $3,733. Now, I'm going to put T accounts up here for notes payable of $140,000 and for interest payable of $3,733. Remember, interest expense is an expense. It's a temporary account. It gets closed out at the end of each year. So that gets set back to zero, but interest payable is a liability, just like notes payable, and it sits on our balance sheet. Now on June 1st, the maturity date or the due date is when we have to pay back all amount owed, the maturity value, which is principal plus 9 months interest. So I have to pay back $140,000 loan principal plus 9 months interest, okay? And so what I'm gonna do is I'm gonna start with the credit. I'm gonna credit cash for the 9 months, and I have to find that dollar amount real quickly. And that amount is $148,398. Okay, that's the loan principal of $140 plus 9 months interest, what we call the maturity value. Now that we've paid back this note payable, I have to get it off my books, my accounting records, or else I'm going to think that I still owe the money, and I don't. So I'm going to debit the note payable. That'll zero it out. So here's my debit to notes payable, $140. I'm going to do the same thing with interest payable. It's just sitting there. I don't owe that money anymore. So I'm going to debit interest payable for $3,733. And in the following time period, 2016, Jan, Feb, March, April, May, 5 months have now gone by. I have to accrue 5 months interest expense to record in the following year's income statement. $933 monthly interest times 5 months is $46.65. I'm going to debit interest expense for $46.65 to recognize the 5 months of interest that occurred in the following time period. So even though we recorded a total of 9 months interest, $8,398, 4 months of it, or $3,733, got recorded in 12/31/2015, and 5 months, or $46.65, got recorded in the year 2016. And that's what accrual basis accounting requires of us, is to record revenues and expenses in the proper time period. Okay, and that's notes payable.